we're can send the right kinds of signals to people. And so we want to understand whether the markets are functioning in that respect to sort of get prices. And then I'll offer some conclusions at the end. I'm happy to take questions at any time. Like I'm used to really like people just ask me questions as we go along. If you want to just sit there and wait till the end, that's fine too. But if there's anything that comes up and you want to ask about it, don't hesitate. Jump right in. Stopped working all of a sudden. Is it the... Okay, I can do that. All right. Okay, so let's start with a really big picture and look at insurance markets. And what we see is that insured losses, particularly for what are called secondary perils, haven't gone up. And you can see that shown in this chart. These are insured losses in secondary perils. So that's severe convective storms like hurricanes, tornadoes, floods, wildfires, and everything else. And you can see these are in real dollars. So this isn't inflation. This is real dollars, real insured losses. So clearly what we see is this trend of insurance, companies are paying out a lot more money now than they were. And what's really interesting is, and perhaps not all that surprising to this group, is that in, now it's working. One of these, or I guess I just have to point. Is there a pointer or no?
It doesn't work well on that screen.
Oh, okay. So I'll just point. What we see in recent years is wildfire contributing a substantial share to global insured losses. So look at these green bars here. In recent years, that's the wildfire losses. And we really didn't have much of anything other than, this is the Oakland Hills fire over here. But, prior to, recent years, wildfires were not that big a piece of the picture. Now they are. If we go to look at California, I wanted to share with you some data that we assembled from a variety of sources, including CAL FIRE red books, if you're familiar with those. And what we can look at here is sort of decade by decade, the total fires in California and the acres burned. And these are drawn as fire perimeters. So you actually see where they are and how big the fires were. So these are individual fires depicted here. And you can see that, back in the 1980s, about 2,400 fires, 3 million acres burned. The 90s were a pretty quiet decade. Things started to really get ramped up in the 2000s, where we were up to almost 7 million acres burned, and then similarly in the 2000s. So this is, that trend. Partly, we're seeing manifest in just a lot more fires and more acres. And what we've seen, along with more fires and more acres burned, are more structural losses. So these are some estimates we put together over the same period and estimated, what were the structure damages in each of these years. We see the Oakland Hills fire, which at the time was just a real outlier, with $1 billion in losses back in 1991. And then, by the 2017, 2018, we're up around 3 to 5 billion. So we've seen in recent years that just are swamping what was considered to be sort of this big, huge anomaly back in 1991. Okay, so that brings us then to insurance markets. And so I wanted to talk a little bit about just basically how insurance works. I'm sure everyone in this room has insurance of one form or another. Sure, auto insurance, probably a homeowner's policy as well. And what you know is that as a policyholder, you pay regular premiums to an insurance company. So what problem are they solving for you? They're basically eliminating risk for you. Because if you have a house and you don't have insurance, then most years you're not going to have any losses. But every once in a while, you're going to get that huge loss, right, where your house burns down. And most people want to avoid that kind of big damage in a given. So what do? You go to the insurance company and you say, look, you take on the risk for me, and I'll pay you a smaller amount every year. And then you basically don't have any risk, because either you make your insurance payment and you don't have a claim, or you make your insurance payment, you have a claim, but you get paid for the loss. Okay, so that's basically how you translate this very uneven kind of outcome of zero or something huge for a small regular payment. Okay, most of us want to do that. What does the insurance company then do? Well, they're going to pay claims to cover your losses according to the terms of your insurance contract. And so, for example, standard homeowners policy is going to pay you your reconstruction costs in the event of a loss due to wildfire. And those terms are all kind of laid out in the fine print of that thing you get once a year in homeowners policy. But how does this work for the insurance company? Like, what is it on their side that makes this worth it for them to take on the risk that you don't want to hold? Well, they can do this through diversification. So what they do is they hold a whole lot of policies. And in particular, what they need to do is get policies that have risks that are negatively correlated. And what that means is that when some of those risks have claims, other ones don't. That means that they're collecting premiums that on policies that do not have claims, and then using those premiums to pay on the policies that do have claims. And so by holding a large enough portfolio of policies, they can basically balance the money coming in for policies with no claims that pay out the policies that do have. Okay? Now, for certain kinds of risks, like wildfire, hurricanes, and floods, as it turns out, the insurance companies have an additional problem, and that is that the risks from these kinds of events can be really catastrophic. So you can get a Thomas fire every once in a while, and insurance companies, like any kind of company, really doesn't want to go bankrupt. They want to avoid insolvency, because that's a huge penalty for that company if they can't cover if they don't take in enough money, their premiums, to be able to pay all those claims. So they're very averse to that. And so what do? Well, they have to hold surplus funds. This is referred to as risk load. For these certain kinds of catastrophic losses, they have to have extra money on hand to basically make sure that they can meet all those claims in a year where they get a catastrophic loss from hurricane or from a huge loss. So that's another dimension of this kind of insurance. What's going on in insurance right now is that risk load appears to really be going up, and it's a big concern for the insurance companies that they not get slammed by one of these wildfires that where they have $1 billion. Okay. Okay, so let's think. We talked a bit about how insurance works. Let's talk about property insurance in particular. So wildfire damages are typically bundled with other perils under a standard homeowners multi-peril insurance policy. So if you buy, go to State Farm and get your homeowner's policy, what are you covered? What's covered and what isn't covered? Well, it's kind of shown here on the right. Wildfire is one of those things that's covered under a standard policy, as are perils like windstorms, and theft and vandalism, and lightning, so on. And then we get into categories of things that are sometimes covered under sort of policies. Things like dog bites kind of depends. Like you have a Doberman Pinscher, you better check your policy. You probably aren't covered under your standard homeowners policy. Sometimes mold, sometimes water damage. Earthquakes, not in California. You need a special, separate policy for earthquake insurance in California, which doesn't come under a standard homeowner. And then there's things that just simply aren't covered. Flooding is not covered. So if you want flood insurance, you have to get it through your insurance company, but you're actually getting your policy from a federal program called the National Flood Insurance Program. It's a federally subsidized program that provides flood insurance. That's a whole other topic for another day, but that's not part of your standard homeowners. Okay, so maybe most of you are pretty familiar with that, and you're probably familiar also if you own a home and you have a mortgage. When you got that mortgage, your bank said you need a homeowner's insurance policy, and so most mortgage lenders require that you have insurance. Why? Because your property is collateral for the loan. So the way that if you don't make terms of your loan, they're going to go and take your house, basically. So they want to protect their collateral, and that's why they make you get insurance. So if we look across the United States, about 95% of U.S. homeowners have these policies, standard homeowners policies, because most people have mortgages. Every year, I just got my renewal notice from State Farm. And this comes every year to me. It provides information about changes to the terms of the contract. For example, my insurance went way up relative to last year. I didn't get canceled. I was happy about that. That's been happening. And if you do lose your insurance, you're going to find out in a similar way that they're not going to find it, fortunately. But the price is higher for reasons that we'll go into as we talk about these markets. Okay, so how about homeowners insurance now in California in particular? So if we look across the whole United States, one interesting thing is that homeowners insurance is provided by private firms for the most part. Okay, it's not true of all, like we just talked about flooding, and that's a public program, but for homeowners insurance and the kinds of perils that are covered, the standard policy, that's a private market that provides this insurance for the most part, and we'll talk about exceptions to that. We look across the whole United States, the total premiums collected in 2021 for homeowners policies were $120 billion. So that's how much homeowners gave to insurance companies for their insurance. California is about 12% of this market. So that's what, like 10 billion, or no, it's a little bit more. It's $15 billion in premiums were paid by California homeowners. Since 2017, wildfire property damage in California totaled $40 billion. Insurance companies got hammered in 2017, 28. They lost a lot of money. If you think they're taking in like maybe 15 billion, then they have a couple of years where they were paying out in total $40 billion. They had big losses. The losses were not as big as sometimes they lose money down in like Florida for hurricanes, but the 17, 18 were big years. So what's been the response? Well, I've tried to tell people in this room that California homeowners have faced rising premiums and reduced availability for insurance in high hazard areas. And what I really want to talk about is sort of what's going on with that. So these are some data that we got from the California Department of Insurance. They're the state regulatory agency, and they collect a bunch of data from insurance companies, and we managed to get this data from them. And what it came as basically what we can observe is for each zip code in the state. So zip codes are relatively small geographic areas. I'll be showing you one in a minute. But for each zip code, we were able to get data on things like the average premium charged, other information, in fact, about sort of their estimate of the average fire hazard in those zip codes. What we did is to organize the data into sort of 5 groups based on this fire hazard. Okay, so took all those zip codes and basically put them into 5 different categories, going from low fire hazard all the way up to the highest fire hazard here. And then we plotted the average premium per $1,000 of reconstruction costs in these policies. And what you can see is, not surprisingly, if you're in a higher fire hazard area, you're paying more for insurance. That's why the orange line is way up above the other lines. But then what's also interesting is the trend. So what we see is pretty flat down here. The premiums have always been going up in the high hazard areas. And then since 2017, they've been going up kind of everywhere, but perhaps particularly in the higher hazard places. Okay, and I'll talk about in a minute why is it that even in low hazard areas, premiums are going up. It has to do with the way in which the regulations work actually for pricing. But this is part of the story, of course, rising average premiums over time throughout the state. We've also seen declining availability of private market policies in high-risk areas. So here on the left, it's the same bins or group bins for wildfire risk. And what we've done is to take the total number of policies in 2009, which are these different groups, and then look at how that number has changed over time. So everything's like normalized on 1. So what this is going to tell you is that since 2009 to 2020, we've seen a decline of about 10% in the number of private market policies being sold in the highest hazard areas. So this is the declining availability that we've been hearing. If people have to have insurance, what do they do if they're not getting it from the private market? Well, they can go to the public exchange, the FAIR Plan. So this here is showing the growth in the FAIR Plan in across all of these different hazard bins. And not surprisingly, it's the really high hazard places where people are getting dumped from the private market, ending up on the FAIR Plan instead. And there's been a pretty dramatic increase of about 20% of policies in high hazard areas since 2009. And I think if we look at updating these data for for an additional few years, that's what all the reports are saying. Yes.
Fire risk, is that based on structure losses and reconstruction, or is that intentional?
That's a good question. So this is I'm not sure so it's a hazard index that the California Department of Insurance develops for each of them. And I actually don't remember. I'm going to show you some other statistics like that, and I can't remember which one a CDI was using actually. For one example, one way to do that is there's a product by the Forest Service called the risk structured data hazard index from that. And I don't recall off the top of my head what CDIs measure. But I'll talk about some of those. I'll talk about some of the way that. Okay, so the story here about how people are moving out of private market policies and onto the FAIR plan, it's really it's happening because of insurers initiating but here's a graph showing insurer-initiated non-renewals, and you can see in the high hazard areas, this is the share of policies that were dropped by the insurer, and on the right, the customer-initiated non-renewals. And so clearly what's happening, sometimes it's the case that a customer might initiate a non-renewal, they get they get their premium notice and it's super high, and they say, okay, I'm going to drop my insurer and go elsewhere. But for the most part, it's happening that it's the insurer who's sending out a notice to the homeowner saying, you're being dropped from our book of business. Okay, so now we'll get into some of the issues of how do we measure risk and particularly how insurers measure risk. So historically, all insurers priced wildfire risk at the book level. So what they did is that an insurer would calculate your premium, and let's say that everything else equal, you're in a certain zip code with what they judge to be a high hazard, you get charged a higher price than the same person, same type of customer in the low hazard area. But the only distinction would be between what zip code you're in. Okay, so that's historically how they did it. Up until about 2010, so of course, this is when the risk, seems like the risk is going up, insurers started to get a lot more sophisticated about how they were trying to measure risk. So we call the zip code level insurers risk rating 1.0. There still are some like that out there, actually, but there's a lot more now what we call 2.0. So after 2010, some insurers began to use property level categorical risk scores. So you may have heard of fire line scores, for that's a 1 through 30 index of wildfire hazard. So it's taking into account things like fuels, slope, how close you are to fire department, and that kind of thing. All that gets matched together into score for your property. So you might, if you have a 1 fire line, you've got a low risk property. If you've got a 30, you're considered high risk. CoreLogic is another group that provides a wildfire risk score. It goes from 5 to 100. Again, it's an index of wildfire hazard. These are private companies, and they're proprietary. These are proprietary data. Okay, so you got to, in other words, you got to go up. They don't just give you data for free. And actually, for this study, after much negotiation, we bought some of CoreLogic's data, and it turned out to be really useful for some of the analysis that we did. So these are the 2.0 firms. They use this index of wildfire hazard. Now there are what we call the 3.0 firms, and more recently they're using wildfire catastrophe models to generate dollar-denominated risk estimates at the property level. So these are not only taking into account wildfire hazard, they've got building characteristics, that sort of thing there too. And they're not just an index, like a number from 1 to 30, they're actually an estimate of what your expected loss is for that property. So it's a dollar value of how much they think a claim could be in a given year on average. And these come out of very sophisticated catastrophe models that basically they try to account for the whole landscape, and they do simulations of fires, and they find out how many times it burned down a particular house or damaged a house, average that all together, and you get these risk estimates. This is sort of the frontier right now for wildfire modeling and wildfire pricing.
Question.
Yeah.
Question is, California Department of Insurance, this last year, had insurance laws with all these insurance carriers all over this. Got 188 models. California Department of Insurance model.
Yeah.
Those models were due probably the last 3 months. So I've had zero luck trying to find out on the books with the California Department of Insurance that that's supposed to be able to see what those models look like. Comment on that. And for luck, so
You mean on these?
yeah,
On
this
these
model
ones,
that
yeah.
they were due 180 days from last year. Apparently on the books for California.
Yeah.
And I just wanted to comment on. No, what's going on in California?
Yeah, so on this issue, I mean, my sense is that you can never really know what's going on inside. These are proprietary models, right? Their business is that, you know, if they just like opened all their books, they wouldn't have a business model. So they make lots of claims about what the models do and how great they are, but it's really hard to judge like how they're, what's really going on inside of them. There was another company called First Street that for a while seemed like it was going to be the kind of open access version of one of these cat models, but that company has recently kind of shifted its business model, so it's pretty clearly becoming much more like the other ones out there and charging money for people to basically learn about what they're asking. I don't know specifically right now about how things stand with the CDI. There's been a big push to allow companies and insurers can use these, but only in a very kind of limited way that I'll talk about. But there's been a push to expand their use for pricing in a way out. Okay, so why does this matter? Why does it matter if you're a 1.0 insurer, a 2.0 insurer, a 3.0 insurer? Well, the reason is that there's variation in wildfire risk for reasons that I'll argue are really important if you're an insurance company and you're competing in a market for homeowners. You can ignore the sampled homes; those are that's for something else. But what I want you to focus on is this zip code. This is 93105 in Santa Barbara, of course, and up into the hills. And what we're showing here is a single zip code, and then giving a sense of the variation in wildfire risk within that zip code. This is using the Forest Service's risk potential structure measure, which is like I forget the scale, but it's a very fine scale measure of the landscape of what's the likelihood of sustaining a loss from a wildfire if you were to have a house at that particular location. And so not surprisingly, if you're on the ocean side of the freeway, you're down or you're in the downtown area, your likelihood of losses due to wildfire are really pretty low. You get up into the hills, though, of course, things are changing a lot. And why this is important is if you're an insurer and you're pricing wildfire risk with zip code factors, if you're a 1.0 firm, you're charging the same price to homeowners this whole area. You're charged for wildfire risk. Of course, houses vary according to other characteristics, but in terms of wildfire risk, you're charging the same price to somebody who's really low risk as you are to somebody who's really high risk. If you're a 1.0 firm, you're a 3.0 firm, what you're trying to do is to be very granular and specific, and you're trying to charge low prices to the dark blue, much higher prices to the homes with those different colors. Okay, so that's going to be that's a really important change that's happened in the insurance industry, and I'll talk about why it matters. This is a table that combines a bunch of data, partly that we got from California Department of Insurance, partly data that we kind of assembled ourselves. So I'll talk about the regulation in a minute, but insurers have to go through a rate filing process. And all of that rate filing, that information is not in a very usable form. There's thousands and thousands of pages of F documents of kind of unstructured information. They're really hard to make sense of, but if you work at it for years and years, like we did, you finally get to understand them, and you can create a table that looks like this. And this is basically showing you how, what kind of information different insurers are using to price risk. Notice because we have a rate file. And basically the pattern here is that the big players are the much more granular, like 0.0 firms compared to the little players. So State Farm, largest market share in the state at 18%. They've got a lot of exposure in high-risk areas, and they use a ton of information to basically price risk. Okay. Beyond the zip code, they're using all these variables to kind of drill down on the property, try to give a much more precise measure of the risk for that property. Come down the list and you get to, well-known companies, big insurance companies like Allstate and Nationwide, but they don't have much going on in California. Nationwide, 2.5 market share, Allstate 5.8, not much exposure in high-risk zip codes. And what they're 2.0 for. They basically just use that wildfire risk score and say, okay, you're at 30 wildfire risk score, boom, that's your price. Okay. Whereas State Farm is getting way more specific about how they're going to price that. And then there's some firms in here who are basically still doing zip codes. Okay, let's next talk about regulation in the state. So if you're an insurer in what's called the admitted market, which is where all the big players are, you can't just charge any price you want. You have to go through a rate filing process with the California Department of Insurance and get your premiums pre-approved. And the way the regulation works is that if an insurer in the admitted market wants to increase their premiums, they can, the calculation that they have to justify is an increase in the average premium across their book of business, which is basically all of the customers. So when they do a rate filing, they say, for example, we want to increase our rates by 5%, 10%, 30%. Whatever it is, I say 30 because that's a recent rate filing by State Farm, by the way. To justify these increases, they have to be justified by historical losses of a 20-year period. So this is really a system that's backward-looking, which you might kind of wonder, is that really a very good way to regulate insurance prices if we're facing risk that's going up like this? and you're making insured look back in time to justify their losses, to justify rate increases based on historical and long-term historical events, right? So 20 years previously. So they look back over 20-year period, and then they can translate their losses basically as kind of a loss recovery mechanism, average increase over their book of business. The key number here is 6.9%. Because if they do a rate filing that requests a rate above 6.9%, they're subject to hearings. And that means they have to go and, like consumer watchdog groups can come in and all kinds of other interested parties, and basically turns into a big sort of open public discussion about what that insurer is asking. If it's 6.9 or below, it's handled as an internal matter by the California Department of Insurance. Eventually, kind of back and forth stuff is all made public, but again, it's buried in rate filing documents. Now we get to the models, how they can use models. So they can't use these forward-looking models like a CAT model to justify overall ratings, but they can use these models to allocate a rating across different properties. These are what are called relativity. So let's say you get approved for 6.9%, you decide, okay, I'm going to make that person 10%, that person 3%. Then you can use CAT models and other kinds of things like wildfire risk scores in order to make that kind of calculation. The recent discussion has been about allowing forward-looking models for the overall rating as well. That's been something that kind of looks like, well, the insurance companies really want it, consumer watchdog groups don't want it, and so I see momentum on that. One thing that insurers, so they can't just set any pricing, but they can largely decide who they want to insure. This is called eligibility. They can say, they can use any kind of model they want. They can basically come up with rules that say, I'm not going to insure this person, I will insure this person, subject to sort of things about unfair, like discrimination. That can't be done, but as far as like doing it on the basis of risk, they can basically decide who they want to cover. If they cover, then they have to be subject to these price regulations. Now, what happens? What else is there out there? If not the admitted market, then you've also got the state-run FAIR plan that is underwritten, by the way, by all the insurers in the admitted market. So they're basically still holding the risk, but the way that the FAIR plan works is you have kind of a state agency that pools together all that risk, and potentially people just can't get insurance anywhere else. You can also go to what are called surplus lines. These are, like Lloyd's of London kind of policies. There are people that are really high fire risk areas around here who end up with surplus line policies. The real disadvantage to one of those is that the admitted market insurers at the end of the day are underwritten by, are backed by the state of California, whereas the surplus lines, it's more of a roll of the dice. Yeah.
So what about the non?
Yeah, that's the surplus.
But I heard that that's supposed to be expensive.
Yeah, and
It was
yeah.
exorbitantly cheaper, and it. So.
Yeah, I mean, I can't, yeah, so my sense is that, so you're saying you found that there was, the surplus line carrier was more cheaper?
And better coverage of
Okay.
travelers.
I hope they made something for it.
Yeah.
Okay, well, I don't know about the specific, about that specific outcome, but that's good.
Berkshire Hathaway.
Yeah, I'm not sure whether they're in the, I'm not sure if they're in the admitted or not, but yeah. Okay, So I mentioned this 6.9, and so this is a chart showing all of the rate filings from 2008 to 2023 that we assembled by going through the rate filing documents, and you can see them all piling up at 6.9%. These are insurance companies who want to avoid a public hearing. It takes a lot of effort and time. It's a much slower process than in the net. And so they basically mostly file 6.9. Recently, though, some of the big insurance companies are going all in, and they're asking for like 30% rate increases, and they're going to be, of course, that's going to trigger public hearings. So one of the questions that's been interesting to us is, if that graph I just showed you kind of suggests that maybe that the insurance companies aren't able to raise the rates because if they're all bumping up against 6.9%, is that some kind of artificial cap on their effort to raise prices? Well, one thing they can do is just to do a whole lot of small rate increases. And this is showing State Farm over time, where they just complete a rate filing for 6.9 and turn around and submit more. And so they're able to ratchet up their premiums actually this process. Yeah.
Two questions. On your last slide, insurers.
Yeah.
How
Yeah, so it varies. The rate filings do report their what they for eligibility, and in some cases they'll say something like so a common one for a 2.0 firm would be we don't take any new policies with a wildfire risk score above some number, something above. Well, say if your property has a wildfire risk score above 30, all states might not rate you. That's the nature of it. Sometimes it gets more detailed. Sometimes it requires like a lot more specific underwriting stuff about like what's the access really look like, or how close are you to fire station. Certainly some building characteristics, just like not too ugly. That kind of stuff. Well, those also building characteristics. But part of it's information out of this kind of rating or like that kind of information is definitely in
that's pretty hard to practice.
oh, so like this kind of stuff.
Very nice.
You mean with the this one?
Yeah.
Yeah. Yeah.
What I'm getting at is for Japanese,
Yeah.
how often do they this how down
I mean, part of this is, oh, sure, yeah. So the question is with these CAT models, are they updating this information on a regular basis? And I think part of it's hard to answer that question because again, these are like proprietary models that are, that are, the companies only tell you so much about what they do. And mostly what they do is they let you have regular models, and how it accounts for everything. And so I think if you ask that question to say CoreLogic, my guess is they would, oh yeah, we're updating. Constantly taking new information. Some of the free stuff out there, like the Forest Service estimate, those are not canonical. The electricity structure is a good product, but I don't remember the last update, but it's not the I'll go here. Okay.
Yeah, so my question about all of this is, we struggle with this every day, whether, does the apple tree in front of my neighbor's house have to go in the zero zone? And it's something we struggle with on a daily basis. This is all black box. The insurance companies own this data, they create the data, they legislators based on this data. And I'm curious whether there's any interest among anybody, the state of California, to open this whole thing up and just say, this is ridiculous. If we can't decide what is the house at risk, how are they going to decide when they're going to put something?
Yeah, I mean, what they're, I agree with a lot of what you said. So first of all, you have insurance, coming from private market firms who are buying information from other private markets within like a very complex regulatory environment, right? I mean, the regulation is designed to California Department of Insurance is about availability, affordability, solvency are its three things that it's trying to do. So that got this private market that basically insuring providing the information, but the regulatory structure is designed to try to be fair to homeowners, to make sure they can get insurance, make sure that firms are solvent too, so that in the event that they have massive losses, that you actually get your claims paid. And so, I mean, I think that's the design of it. There's other ways to go though. So, you could imagine a public model, right? Rather than having, these black box models from private firms, you could imagine a public model that's run that, is transparent, understand exactly what's going into it. That's what they've done in Florida with hurricanes. So the public risk model in Florida, but alternative to some.
Well, you mentioned Florida, so is some of your work cover nationwide insurance rates?
Oh, yeah, actually. So I'm going to talk about some of the analysis we did, but so what's really interesting, it's really interesting if you spend 5 years on insurance, things have a way of becoming fascinating. But what we were able to do through these rate filings, we can reconstruct exactly what insurance companies would charge differently. Okay. Because the rate filing is a formula for your price. If you know all the inputs, you know what the price is exactly, which is kind of amazing. It's not like when you go into your state farm office and how much is it? Not just kind of making something up on the fly. They're putting in your information that goes directly into a formula that spits out the price that is pre-approved through the rate filing process. Okay. What we did is to get all the data we needed to plug in for 100,000 homes in California, got the data to be able to say exactly what Nationwide would charge you, what Allstate would charge you, what State Farm would charge you, and several other ones as well. So that's what, so I'm going to show you some of that data, a sense of how are these companies different in terms of how they price wildfire.
Guess the next part of the question. So we were here.
Yeah.
So, chiefs, one of the chief from Cal Fire, said, Cal Fire insurance said, as it's going up here, it's going up much faster. So in my head, say, got it. Well, it's much more likely for a tornado to take place in Texas.
Yeah.
Or a hurricane than a fire to happen in the same place.
Yeah.
To rebuild
Right.
by the next week. So is it a regulatory thing? That's they're not. Is there, are they actually seeing this? I don't think it's that. I don't think they're modeling this.
Yeah, I mean, so I think that's a great distinction, and I mean, and actually we go to the hurricane states, and their loss years, they're much bigger than experience. Hurricanes, are really a bigger problem in that sense, and like you say, there's no, you can get a hurricane in exactly the same place too. So, with a wildfire, that seems kind of unlikely, but basically done a massive. Seems like that's probably not as likely to happen. Yeah. Right. So that's the question. I think it gets the question asked before, like, do they update these models? I don't know. Like, I'm sure CoreLogic would say, oh yeah, we're accounting for that in our assessment. But hard to know. We don't get to see how they're doing. But they should be.
I talked to insurance today, trying to cover freeway side of Bishop Diego High School.
Yeah.
No one will cover us. Say we're in a high fire. That's the term.
Yeah.
Maps. So, and I've heard from other insurance that outside of states.
Yeah.
So is that part of those models you're talking about? How fire?
Yeah,
Whatever
probably.
maps?
I mean, I think it would depend on which different insurer models, but there's not that many out there. And so, yeah, if it's, my guess is that if State Farm said I want to know you're on the side of the way, my guess is they aren't writing policies. They're not writing policies. And it would be based on their, on their models, which, maybe accurately not.
So I can go online and I can add insurance online. That's the. So, but that's the insurance company, right?
Right?
There's not,
So
that.
in the Paradise Fire, people have insurance with that. They solve Paradise Fire. So I'm not, I mean, I think that might be the trade-off. Okay, yeah, so I'll wrap it up if I'm, real quick, and then I'll wrap it up, yeah.
Going back to, I guess, the last slide showing, insurers can't raise rates more than 6.9%.
Yeah.
But I'm hearing off of people,
Oh, they can, but then they're subject to a public hearing.
Yeah, so I guess what does that process look like? Is it like NEPA where they're required to do like hearings for the projects, but they don't want to change it to do without the project they want to do, that someone with this. They're just gonna go through the pain of a public hearing, you know, do whatever they want.
Yeah, but it open, you know, they can request anything they want. They have to justify it based on historical lawsuit, right? But then, if they do that, then, you know, there's a lot of scrutiny given to it in public. And, you know, they probably costly for them. Then it takes a long time. You know, there's objections and then responses and all of this stuff gets played out over a long time. So you can see, they just don't do it very. It's been better for them to just go for serial 6.9 and avoid the headache. But we're about to see a lot more public hearings because the big companies are going for big rate increases.
I guess what we're hearing all the time is that our premium went up like 50% or 50%.
Yeah, so that's what they're doing though. That's how they're applying the relativity. So they got like a 6.9. Someone else probably didn't get a rate increase, and then yeah, on average they have to do 6.9. Yeah. All right. So let me just like just say a little bit about this question about are premiums aligned with risk. And you know, the point here is that property insurance markets have a critical role to play in helping homeowners reduce exposure to risk and cover homes hazards that occur. So if you think about premiums that are aligned with risk, they are sending signals to customers or homeowners about things like where they build houses, and also things that this group is like self-protection, so actions to hazards and vulnerability. If insurance is priced to reflect risk, then that should align the kind of incentives to things like make decisions about where to build, or take appropriate actions to avoid risk. And so what our research is showing is that in high-risk segments, these high premiums and lack of availability is actually due to suggest that prices are not well aligned. And it's due to this problem, what I'll talk about, I'll try to make this brief. So are we sort of out of time or? Okay, all right. I want to talk about just quickly about what we've detected as the phenomenon of adverse selection among insurers. And so the way this is working is what we've seen is there are differences in information used by insurers that price wildfire. So we got the 1.0s, we got the 3.0s. And so if you're a low information insurer setting one price for risk, wildfire risk in a zip code, you should really worry about getting a lot of the bad risks when you're competing with a high company, right? Because that high information company, the 3.0 company, knows a lot more than you do. So for example, Allstate and Nationwide price wildfire risk using a CoreLogic wildfire risk score. This 5 to 100 index wildfire hazard, whereas State Farm comes in there and uses highly granular results from the catastrophe model that price their risk. So, you know, for a wildfire risk score of 30, Nationwide is charging one price. All customers with a 30 wildfire risk score. State Farm recognizes that there's a lot of variation in risk within that category of 30 score, comes in and potentially can price risk differentially to the customer. So what our research shows is that when Allstate and Nationwide are charging a single price for wildfire risk to customers with wildfire risk score, State Farm is charging different prices. And in particular, what they're doing is they're picking off the low-risk customers in that segment, okay? Because they have better information about risk. And that leaves Allstate and Nationwide with what's called an adversely selected group of high-risk customers. So this is the adverse selection problem for a low information firm, is you might end up with a bunch of the bad risks because you don't know as much about the risk distribution as your competitors who have better information. And so what do you do if you're Allstate and Nationwide? They know that State Farm is using a lot more information, price risk, and Allstate and Nationwide can go and look at rate files just like we did. So what do they do to avoid adverse selection? They raise prices to reduce their exposure to getting all these high-risk customers. They're still charging a single price for wildfire risk score 30, but they just charge a really high price, and particularly to their existing customers. And then they restrict eligibility in high-risk areas. They just say, we're not going to price in those areas because we don't want to get stuck with all those high risks in competition with a state farm or farmers. And so because we're able to perfectly reconstruct the prices that different companies charge for different kinds of homes, we are able to document this. And so there's a lot going on here, but let me just try to sort of make the point. Each of these dots here is one of those wildfire risk scores. What we're seeing is the premium that different companies would charge for a customer with that wildfire risk score. Now, of course, houses differ and customers differ, but we're standardizing that across all of this data. So this is not due to, it's not because Allstate, insures certain types of customers. Customers are all the same, all standard. So this is only showing us information for a typical customer about how much they would be charged, and the only thing that's varying is the company and the risk. So what this says is if you've got a really high wildfire risk score, Allstate and Nationwide are charging you a really high price, right? And they're doing that because they know they're competing with State Farm over here, who is charging lower prices in order to get those lower risk customers. So this is, you might say, well, why doesn't State Farm raise their prices? Well, they're actually keeping them low to get the lower risk customers. Allstate and Nationwide are saying, oh man, we're going to get the bad risks and we're going to just price really high. And this comes out exactly in these data. The other point I'll make is that the dotted line there is showing the if they price perfectly in a way that aligns with risk, these dots would actually lie along that line or within the gray area to account for risk load. So State Farm is charging pretty much risk-aligned prices, but these other companies are charging much higher prices that are not aligned. And it's because of, we argue, because of this adverse selection problem that they're facing. So that, in other words, is part of the story for why we're seeing these really high prices. Part of it's rising risk, but part of it's this information kind of problem that some of the insurers are facing. Yeah.
So I guess this is the core logic of ours.
Yeah, right.
So State Farm, the yellow or high
Yeah.
points there. It's under the assumption then that their models are actually rated as say versus cells.
No, so this is these are four customers with a wildfire risk score, let's say 80. What would the price be that State Farm is charging? And it's lower is what we're talking about.
But like for their models, you would assume those kind of 80 numbers in their models would be a lower wildfire risk score.
Well,
score of nationwide.
it would be, I think how I would put it is, their model would say there's a bunch of customers with 80 wildfire risk score, but we know something about this. Within that 80 scores. There's kind of low risk people and high risk. We're gonna price, get the low risk ones. The high risk ones to the all states. All state and nationwide, I look at an 80 wildfire risk score customer and they just see score customer. That's what state farms identifying lower. Precisely, and then
And they believe their models are more accurate.
they do. I mean, so there is a question like, do they know? Do they know better? I mean, the fact is that there's a sense in which whether or not those models are really accurate, is a little bit beside the point. They're pricing according to this approach, and they're at least they're charging lower prices, but they're forcing the Allstate and charge really high prices to avoid basically getting at least what they perceive to be the highest. And so the other thing they're doing is restricting, as I mentioned, is eligibility. So here, this is looking at State Farm, Allstate, and Nationwide, and you can see that what Allstate and Nationwide will do is basically just cut you off at a certain point and say, we're going to take State Farm, this area. Customers, but this is for new customers. So the insurance companies tend to stick with who they've got because they know those people are loyal. In other words, loyal means they'll pay really high prices. And so, but for new customers, the Allstate and Nationwide are dropping out way before State Farm because would be another response to the adverse selection as well. And so, with that, let me just I'll just wrap up now. So we've seen natural disasters increasing, including wildfire risk in California. Admitted market insurers have responded by raising premiums, limiting coverage in high-risk areas, and adopting more sophisticated wildfire risk pricing. We haven't found evidence that really says that regulation is restricting upward price adjustment, although this is what the insurers often argue that the problem with regulation. We're not seeing that because they do their 6.9 over and over again. We do find evidence of this adverse selection, however, driving high premiums in high-risk areas and also contributing to a misalignment of premiums and risk. So with that, I'm done. Thank you.
Thank you, Andrew.
Yes.
Quite a bit of information, a little eye-opening for everybody, I'm sure. So
Great.
thank you.
Yeah.
Yeah.
You're welcome.
No more questions for Andrew? Yes.
Yeah. And only here for nothing to gain for these homeowners who are harming their homes and really mitigating against wildfire.
Yeah.
Articles that survey us. And otherwise, so, I mean, I was hoping people hire these skills that are doing what we should to slide and
Yeah, so what we've seen, we were really interested in that question, and actually, as we dug into the rate filings, for the most part, sure, it's like, we're basing eligibility on things like firewise pricing and status as a firewise. But what happened, what changed though, is this, and I don't know exactly what the stage is, but the Safer from Wildfire program, CBI saying, gotta, requiring the admission market insurers that actually offer for home party, that kind of stuff. So, my sense is that I think that the policy that was adopted is coming down the road, so that insurers are going to have to. That we were surprised that they see in the rate filings that it wasn't, once we looked at it, and the company looked at, there wasn't mechanism for prices to adjust things. Actually, of course they could.
All we've seen is, I think, yeah, last bullet point, climate and risk, it makes sense that we're going up. But I think they're going to the point where it doesn't make sense to the budget, because the done at commercial level by the government, and then a landscape level by government, departments, whatnot, that can reduce risk, which is what that's where they pumped in premiums. So it's kind of what we're seeing in new normal, because it seems like they're trying to rebuild their coffers after these huge losses they've had. So when they get rebuild those coffers, or will they kind of make the point like, okay, better about now at risk mitigation being done at commercial and level, oh, go back down. That potentially happen in the future.
It's a good question to me. Yeah, so the question is, going forward, whether we see, are we gonna see, premium increases, for as the insurers are trying to see losses. Eventually, will we see it come down, particularly if there's hazard mitigation activity? Yeah, hard to say. I mean, the sort of like profit maximizing companies, and it has this feel of somewhat of a game they play against the California Department of Insurance to basically provide that. On the other hand, they have to worry about the customers too. I mean, they have to worry about how they treat people, because there is competition in the market. Something. So I guess I think we're going to see probably some big increases in return, because that's what that's what the companies are going for. They're I think positioning themselves to some degree by doing things like saying operating policy, et cetera. But longer term, maybe through safer from wildfire programs, we'll see more of it. I do think this information problem there, that's one where maybe we start thinking about public models and that, so that all the insurers are similar. Really different in the information that's in driving on places like this.
I agree with that. As smart as they models are, as good as my thoughts of other incredible. Many of the cases that I have, owners from the fire department, say fire department, take that insurance company. The model or the result of say C model, was ridiculous. Like example, homeowner in Los Olivos, saying about last field type was denied policy. So yes, as the crow flies, you could say it was 20 miles from the anywhere. But it was, doesn't down because ever happened here. It's not a chaperone. So on and on and on. So it's really pointed to somebody's under if they state accepted on this now, the great leagues was updated. Right. This now. That it's just like flood gap, right? Like flood risk. That's not some black box. That's even flood risk. Right?
Although that's also because companies or communities exist.
Of course, because of flood. And we see the same thing. So fire has areas on the fire. I took it as risk county. I can tell you that in this county, there were many people asking emails to Cal Fire. Gary raised my county insurance. But me as a public servant, hazard now being one, oh, this should be objective,
Right.
Insurance policy. Sorry, but it should not be a whole time.
Yeah, so that, I guess, the trade-off, right? It's, if it's a public product, then there's gonna be sort of like public. So, if it's a private product, then there's a black box.
Question two, fair plan subject.
No, I don't think it is. Their pricing is supposed to be just like actuarially fair, boom, this is the risk we're gonna price it. But I think they can rate products, however. I think they have different mechanisms. I don't think they're subject to that same kind of restriction.
Here's the point, there's that fair plan secretary, respect my own. It's talking about risk and mitigating risk, fire code. All my stuff I did, life and fire code, she had no clue, stop.
Yeah. So, and this is on, not on building. On building code.
Physical space. She, person, compartment that she had.
Right, yeah. Yeah, I don't know too much about that, but I know that, know that they have. Supposedly. Supposed to be this. Okay, well, thank you for all your great questions.
Thanks again, Andrew.
Okay.
Appreciate it.
Yeah.
Thank you. Thank you very much.
Yeah.
So any community updates? Anybody want to discuss anything? Okay, now that being said, I think we're at the end of our agenda. Yes, Anne-Marie?
Socializing.
So hang out and then grab some food and chit chat amongst yourselves. All right. Thank you for coming. Appreciate it.
Hey, would it be okay if I take my presentation off of there? Oh, it got recorded?
Oh, sorry, not one. We cannot push that.
You don't have to post it. You don't have to.
Yeah, I mean, it's just that like we're about to release this and there's potentially, you know, I don't know, some of this, we'd like to kind of control the